Welcome everyone. My name is Phan and I'm an independent certified financial planner practitioner. Today, we will learn about annuities and their purposes. An annuity is a contract between the client and the financial institution. The best type of annuities depends on the client's goal and objective. Are the clients looking for growth, income, or both? Contribution can be a single lump sum or whatever amount you like. Income payments can be fixed or variable. Income payments can be lifetime for you or for both you and your spouse. Income payments can be a combination of fixed or variable and lifetime income for you or both you and your spouse. Premium funding options. Single premium immediate annuity, SPIA. One-time deposit into the plan and you want income now. Single premium deferred annuity, SPDA. One-time deposit into the plan and you want income in the future. Periodic premium deferred annuity, PPDA. You can contribute whenever and how much you want depending on the types of annuity and you want income in the future. Annuity payout options. Fixed period, 5 years, 10 years, 15 years, 20 years, 25 years fixed period annuity. For example, you pick 20 years fixed period annuity because you only want income for 20 years. After the 20th year, the contract ends. Fixed amount. You only want $3,000 a month and the insurance company will do the calculation to see how many payments you will receive based on the $3,000 a month income you want. Straight life annuity. Lifetime income for the rest of your life. Joint and survivor. Lifetime income for you and your spouse's life. Life annuity with period certain. Let's say you want life annuity with 10 years period certain. If you pass away before the end of the 10th year, your beneficiary will continue to receive the payment until the end of the 10th year. If you live past the end of the 10th year, you will continue to receive the payout until you pass away. You can think of it as the end of the 10th year or your life, whichever is greater. Different types of annuities are fixed, variable, equity index, immediate, and deferred. Fixed annuity characteristic. The money is invested in the insured general account. Insurer bears the investment risk. The insurer will guarantee a minimum interest rate. There is fixed growth where you can cancel the policy at the end of the term or renew it as you please. There is also fixed income where you receive a fixed income payment. This plan is suitable for conservative investor. Variable annuity characteristics. The money is invested in sub-accounts. You can think of sub-accounts as investment accounts. The contract owner of the account picks the investments. The contract owner bears the investment risk. The income payments vary depending on the option you pick. This plan is suitable for high-risk investor. Equity index annuity characteristic. Investment returns are linked to an index such as the S&P 500, Russell 2000, MSCI, etc. The contract owner of the plan picks the investment. The insurer guarantees a minimum return and the return is capped at a maximum. The income payments vary depending on the option you pick. This plan is suitable for moderate risk investor. Immediate annuities characteristic. Insurer bears the investment risk. The first payments generally begin one payment period following the premium or deferral, which is sometime in the future. Deferred annuities characteristic. Who bears the investment risk depending on the type of annuities. You can receive lifetime income now, later, or never. One of the main objectives of this type of annuity is to defer the taxes. Why do investors buy annuities? They don't want to run out of money. Predictability. Investors know they have a consistent income coming in every month to pay their bills. They don't want to actively manage their portfolio to match their withdrawal rates to changing financial market conditions. What I mean by this is the financial markets goes up and down and it is unpredictable. Because of this unknown variable, You have to actively have the right mixture of investments in your portfolio and how much money you can withdraw out of your portfolio so you don't run out of money. It is a lot of work and it's not guaranteed. The best way to purchase an annuity. The best way to purchase an annuities is to ask yourself, what are you trying to accomplish? Then pick the annuity and rider to accomplish that goal. The total fees of the annuity is important, but what you are getting for the fees matter more. Does the annuity have up to 10% of account value withdrawal free of surrender charges feature? The insurance companies are the one that promises to pay the lifetime income, so you want a solid company that can back up their promises. Remember, guarantees depends on the company's financial strength and claim paying ability. When you look at the illustration, you want to know what are the guarantees. The hypothetical doesn't mean much because anyone can project a nice hypothetical illustration to make the annuity appealing. Shop around, talk to a professional, and take your time. When should you not buy annuities? Annuities are not for everybody. It really depends on your financial situation. One example is I have a client who is a nurse and she is getting 75% of her 3 highest consecutive annual incomes. She has enough money to pay her bills, travel, and give money to her family. In her situation, she does not need any annuities. We built a low-cost investment portfolio for her. You can achieve the same goal in a better way. For example, you have a long-term horizon and you want to grow your money but scared of a decline in the financial market. You might be better off building a low-cost, diversified investment portfolio than buying an annuity because you don't have to pay for the extra fee that comes with an annuity. Be cautious of annuities with high fees, long surrender period and high charges, poor participation rates, cap rates, floor, and spread rates if any. The premature distribution rule, poor performing investments inside the annuity. Twisting and churning. If you are replacing an existing annuity with a new annuity, be sure to fully understand all of the advantages and disadvantages that comes with the existing annuity and the new annuity. Common questions on annuities. Do annuities have high fees? It depends what types you buy. Normally, variable annuities have high fees and fixed and SPIA have very low fees. Do I need my spouse to sign a waiver for single life annuity? From my experience, yes. A single life annuity provides the largest payout. The spouse might sign a spousal waiver witnessed by a plan official or notary in order to elect a single life annuity. What are the top low-cost annuities? The financial institution is constantly updating and changing their annuity products to compete in the marketplace. Thus, you want to reach out to a professional and ask him or her to shop around for you. What are the disadvantages of an annuity? Buying the wrong annuity with high fees and long surrender schedule. Tax treatment of annuities. To understand how annuity will be taxed, we have to understand how it is being funded, who owns the annuity, and who will receive the income. A general guideline is if we are funding the annuity with pre-tax dollars, such as money inside of a traditional IRA or 401k, all of the income coming out of the annuity will be taxable because we have not paid taxes on the money. Funding the annuity with after-tax dollar, such as money coming from a saving or checking account. Income is considered partially return of principal and partially taxable income. Funding the annuity with Roth IRAs and Roth 401k, no tax on the income. Of course, everything has to be done correctly. We have to be careful with the rules and exceptions. Additional 10% tax on early distributions. I want to add this rules in the video because it is important to know. This is directly from the IRS. If you receive pensions or annuity payments before age 59 and a half, you may be subject to an additional 10% tax on early distributions unless the distribution qualify for an exception. The additional tax doesn't apply to any part of a distribution that is tax-free or to any of the following types of distributions. Distribution made as a part of a series of substantially equal periodic payments that begin after your separation from service. Distribution made because you are totally and permanently disabled. Distribution made on or after the death of the plan's participant or contract holder. And distribution made after your separation from service and in or after the year you reach age 55. Exception to the additional tax of 10% withdrawal rule made before you reach age 59 and a half. Purchase annuity before August 14, 1982. It doesn't apply to any part of the distribution that is tax-free. Immediate annuity because it satisfies the substantially equal periodic payments exception. Internal Revenue Code 72T1. August 14, 1982. If you purchase non-qualified annuities before August 14, 1982, withdrawals are first in, first out, FIFO, and no 10% penalty. Which means if you withdraw from your annuity, your principal is counted first, then anything above your principal is considered taxable income. Withdrawal is different from lifetime income. Lifetime income counts as part principal and part taxable income. If you purchase non-qualified annuities on or after August 14, 1982, withdrawals are last in, first out, LIFO, which means withdrawals count as taxable income then principal. Here is a direct quote from the IRS. If you bought your annuity contract before August 14, 1982, a different allocation applies to the investment before that date and the earnings on that investment. To the extent the amount withdrawn doesn't exceed the investment and earnings, it is allocated first to your cost, tax-free part, and then earnings, your taxable part. Non-natural person, like a corporation, owns an annuity. Gains are taxed as ordinary income. Losses are treated as ordinary losses. No tax deferral. There are other exceptions to the rules that I did not cover because I have not encountered any clients where the rule applies to them, such as August 14, 1982 rules. Please note that all of my videos are for educational purpose and you should talk to a professional before making any financial decision. You need to fully understand the financial products you are planning to buy. If you have existing financial products, you want to understand what you have and how it works. Questions to help you understand your annuities. How does this annuity work? How is this annuity suitable for me? What can this annuity do for me and my family? What are the risks? What are the guarantees and how long do they last? What is the free look period after I purchase the annuity? The free look period is the right to cancel the contract without penalties and charges. The free look period is normally 10 or 30 days depending on the state and how old you are. What are the available riders and how much does it cost? What is the surrender schedule and fees? How much can I withdraw from the annuity without penalties each year? How will this annuity impact my tax liability? What will happen to the annuity if I am deceased? How I use annuities with clients. They are conservative, don't want to lose money, and want to grow their money. They want lifetime income regardless of the financial markets. You can visit the IRS publication 575 to learn more about annuities. Thank you for watching. This is Tan, your trusted advisor.